Welcome to Cashflow Positive, your go-to channel for all things finance and investment. Today, we're diving into a topic that's a game changer for anyone looking to get their feet wet in the world of investing: how to invest your first $1,000. Now, before you scoff at the seemingly small figure, remember, every financial journey begins with a single step. That first $1,000 could be the seed that grows into a mighty oak of financial stability. Investing isn't just about making money, it's about creating a future where you're financially secure. It's about making your money work for you and allowing it to build over time. Whether you're looking to save for retirement, a down payment on a house, or just want to get a taste of the investing world, this video is for you. Understanding how to invest your first $1,000 can be a stepping stone towards financial freedom. Before you start investing, you need to know what you're aiming for. Now, that's not just some throwaway line, it's a fundamental principle in the world of investing. So let's dig a little deeper. Think of your financial goals as your investment roadmap. They're there to guide your decisions and keep you focused on the destination. Without them, you'd be cruising down the financial highway without a GPS, and let's face it, that rarely ends well. These goals, they need to be clear and realistic. Daydreaming about becoming a billionaire overnight might be fun, but it's not going to help you make sound investment decisions. Instead, consider what you want to achieve financially in the short, medium, and long term. Short-term goals could be anything from saving for a vacation, building an emergency fund, or making a down payment on a car. These are goals you'd want to reach within the next couple of years, and they're usually best served by safer, more conservative investments. You wouldn't want to risk your hard-earned vacation fund on a volatile stock, would you? On the other hand, long-term goals are typically more substantial and might include funding your retirement, buying a house, or setting up a college fund for your kid. These goals often require a more aggressive investment approach, as you have more time to recover from any potential market downturns. But here's the key: your investment strategy should be a balance between these short and long-term goals. It's like a financial tightrope, and your goals are the balancing pole. Also remember, our financial goals aren't set in stone, they're dynamic, evolving with our life circumstances. Got a promotion? Maybe it's time to up your retirement contributions. Starting a family? Perhaps a college fund is now on the horizon. In essence, your financial goals are your compass, guiding you through the investment landscape. They help you make informed decisions, reduce the risk of emotional investing, and keep you on track towards achieving your financial dreams. Remember, it's your money and your future. Make sure your investments align with your personal financial goals. Now that you have your goals, let's dive into the investment options available to you. First up, we have stocks. When you buy a stock, you are buying a tiny piece of a company. You're becoming a part owner, if you will. If the company does well, your stock increases in value, and you can sell it for a profit. But if the company doesn't do well, the value of your stock may decrease. This is the risk you take when investing in stocks. Next, we have bonds. Bonds are essentially loans you give to a company or the government. You lend them money, and in return, they promise to pay you back with interest over a specific period. Bonds are generally seen as less risky than stocks, but the potential returns are also lower. Then we have mutual funds. Think of a mutual fund as a basket that holds a variety of investments like stocks or bonds. When you invest in a mutual fund, you're pooling your money with other investors to buy a wide range of assets. This allows you to diversify your portfolio without having to buy each individual investment yourself. Lastly, we have exchange-traded funds, or ETFs. They are similar to mutual funds in that they also represent a collection of assets. The difference is, ETFs are traded on stock exchanges, just like individual stocks. This means you can buy and sell ETFs throughout the trading day at fluctuating prices, unlike mutual funds, which only trade at the end of the day at a set price. Each of these investment options comes with its own potential risks and rewards. Stocks can offer high returns but are also high risk. Bonds are lower risk but with lower returns. Mutual funds offer diversification and professional management, but they also come with fees and less control over individual investments. ETFs combine the diversification of mutual funds with the flexibility of stocks, but their prices can fluctuate throughout the day, which can be a double-edged sword. As a beginner investor, it's important to understand that there's no one-size-fits-all investment. What works best for you will depend on your financial goals, your risk tolerance, and your investment timeline. Do you want to grow your wealth quickly, or are you more focused on preserving what you have? Are you comfortable taking on more risk for the possibility of higher returns, or would you prefer a more conservative approach? Are you investing for the long term, or do you need your money back in a few years? Understanding these options will help you make an informed decision about where to invest your money. Remember, investing is not about getting rich quick. It's about growing your wealth steadily over time. So take the time to understand these basics, and you'll be well on your way to becoming a savvy investor. Putting all your eggs in one basket isn't a wise move when it comes to investing. This old adage rings particularly true in the financial world. To put it simply, diversification is the strategy of spreading your investments across various assets to reduce risk. Imagine you're at a buffet. You wouldn't fill your plate with just one type of food, right? Similarly, you wouldn't want to put all your investment dollars into a single stock or bond. Instead, you'd spread it across a variety of dishes, or in this case, assets. This could include stocks, bonds, mutual funds, ETFs, and real estate, among others. Diversification helps to reduce risk because different asset classes perform differently at various times. When one asset is down, another might be up. It's kind of like having a balance wheel on a watch. It helps keep the watch running smoothly, no matter what bumps or jolts it might encounter. It's important to keep in mind that diversification doesn't necessarily mean you'll avoid losses. Even a well-diversified portfolio can experience downturns, especially in a bear market. However, the key point here is that diversification can help to soften the blow. Let's delve a little deeper. A diversified portfolio is not just about having a mix of stocks, bonds, and other assets, it's also about having a mix within those categories. This means having a variety of stocks from different sectors or industries, and bonds with different durations and credit qualities. To diversify your portfolio, you don't need to be a Wall Street whiz or have a seven-figure bank account. Mutual funds and exchange-traded funds, ETFs, are perfect for beginners as they offer built-in diversification. These funds bundle a variety of assets together, so with a single purchase you can own a slice of many different companies or bonds. Remember, the goal of diversification is not necessarily to boost performance. It won't guarantee gains or promise to shield you from losses, but it can help to spread risk and smooth out your investment returns over time. A diversified portfolio can help you weather the ups and downs of the market. So when it comes to investing, don't put all your eggs in one basket, scatter them far and wide. Investing always involves some level of risk, but there are ways to manage it. This statement may sound a bit daunting, but don't fret. With a few smart strategies, you can master the art of risk management and ensure your investment journey is as smooth as possible. Firstly, establish a budget for your investments. This is a fundamental step and shouldn't be overlooked. It's essential to set aside a specific amount of money that you're comfortable with potentially losing. This doesn't mean you will lose it, but it's a safety measure to ensure your financial stability. Secondly, make a habit of routinely reviewing your portfolio. This should be a regular part of your investment routine. The market is constantly changing, and so are the performances of your investments. By keeping a close eye on your portfolio, you'll be able to make necessary adjustments and keep your investments in line with your financial goals. Thirdly, diversify your investments. This is one of the most efficient ways to manage risk. By spreading your investments across various sectors, asset classes, and geographical locations, you can reduce the likelihood of a single event severely impacting your portfolio. Remember, don't put all your eggs in one basket. Fourthly, avoid emotional decision-making. Investing should be a rational process, not an emotional one. Making decisions based on fear or greed can lead to poor investment choices. So, always stay calm, analyze the situation, and make informed decisions. Lastly, consider seeking advice from a financial advisor. They can provide valuable insights and advice tailored to your specific financial situation and goals. While their services come at a cost, their expertise could potentially save you from costly mistakes and guide you towards better returns. These are just a few tips to get you started on your risk management journey. As with all aspects of investing, it's a learning process. The more you invest, the more you'll learn, and the better you'll become at managing risk. Remember, risk management is a key part of successful investing. So take these tips to heart and start implementing them in your investment strategy today. Scene script. Ever heard of the phrase, money makes money? That's compound interest. Imagine a snowball rolling down a hill. As it rolls, it picks up more and more snow, growing in size with each rotation. This is a simple way to visualize the power of compound interest. But instead of snow, it's your money that's growing. Compound interest is when the interest you earn on your investment also earns interest. Sounds simple, right? Well, the impact it can have on your wealth over time is anything but simple. Take this scenario for instance. If you invest $1,000 at an annual interest rate of 5%, after 1 year, you'll have earned $50 in interest. If you leave that money in the investment the next year, you'll earn interest on $1,050, not just your original $1,000. This means you earn $52.50 in your second year. That's an extra $2.50 you've gained just by leaving your money to grow. Now $2.50 might not seem like a lot, but remember, this is just the second year. The true power of compound interest lies in the long term. Fast forward 20 years, and that initial $1,000, without adding any more money to it, grows to $2,664.01. That's over 1.5 times your initial investment, all thanks to compound interest. This is why Albert Einstein is often quoted as saying, "Compound interest is the eighth wonder of the world. He who understands it, earns it. He who doesn't, pays it." The magic of compound interest lies in its ability to multiply your money over time. It's the reason why starting early and staying invested is so crucial. It's the reason why every dollar invested today could be worth much more in the future. Remember, patience is key. Let your money roll like that snowball, growing with each rotation, and you'll see just how powerful compound interest can be. Compound interest can be your best friend in the world of investing. That's your crash course on how to invest your first $1,000. We've covered a lot of ground today, so let's take a moment to revisit the key points. Our journey began with a deep dive into assessing your financial goals. Remember, an investment journey is a personal one, and it's crucial to understand what you're aiming to achieve. Whether it's generating a passive income, saving for a home, or planning for retirement, having clear goals will guide your investment decisions. We then moved on to the basics of the stock market, bonds, mutual funds, and ETFs. Investing isn't just about buying low and selling high, it's about understanding what you're investing in. Equities or stocks represent a share in a company, bonds are essentially loans you give to governments or corporations, mutual funds are a pool of various investments managed by professionals, and ETFs are a basket of securities that you can buy and sell like a stock. We also emphasized the importance of a diversified portfolio. Diversification is akin to not putting all your eggs in one basket. By spreading your investments across different asset classes, industries, and geographical regions, you reduce the risk of a single investment hurting your overall portfolio. Our conversation wouldn't be complete without tips for risk management. Investing always involves some level of risk. However, you can manage and mitigate these risks by understanding your risk tolerance, diversifying your portfolio, and keeping a long-term perspective. Finally, we explored the power of compound interest. Albert Einstein once said that compound interest is the eighth wonder of the world. It's the snowball effect of your money growing over time, where you earn interest not just on your initial investment, but also on the interest you've previously earned. It's a powerful tool in your investment arsenal, especially when you start investing early. Now it's your turn to put these lessons into action. Start with a clear financial goal, understand the investment options, diversify your portfolio, manage your risks, and let the magic of compound interest do its work. Remember, the journey of 1,000 miles begins with a single step. The same applies to your investment journey. If you found this video helpful, don't forget to hit the subscribe button for more financial tips, and give this video a thumbs up. Remember, every great investor started somewhere, and you've already taken the first step by learning how to invest your first $1,000. Here at Cashflow Positive, we believe in your potential to achieve financial freedom. Until next time, keep investing and stay positive.